Good evening, ladies and gentlemen. I'm Ankita Sahani. I welcome you all to the launch of the UTI Mutual Fund Swatantra series on ET Now. This series is a unique and interactive investor education series envisaged by UTI Mutual Fund, which is in its 50th year of creating wealth and contributing to the financial sector of the country. Without further ado, I would like to invite Mr. Leo Puri, Managing Director of UTI Mutual Fund Asset Management Company, and Mr. M.K. Anand, Managing Director and Chief Executive Officer, Times Television Network, to come onto the stage and unveil the logo. So this is the moment we have been waiting for. Huge round of applause, ladies and gentlemen.
All of us at UTI know the importance of Swatantra. I think it's been one of the most innovative, I would say, initiatives that UTI has undertaken. And I think it's really helped position us in a remarkably different way. I think with ET Now, I really hope we can take it now through an electronic medium and perhaps reach new investors that we had not touched through print, and perhaps even connect with a younger generation, which is something, of course, we're very keen to do.
Taking the benefit of the stock markets, benefit of mutual funds to Indians at large is absolutely congruent to what we at ET Now want to do for the channel. In fact, if you look at our viewership, you see that our viewership is better in the younger age group. Our viewership is better in markets beyond the traditional Bombay and Gujarat. This is an initiative that we are very, very happy and very proud to be partners of, and we will ensure that it is sort of taken to levels way beyond what it is right now, because obviously the power of television, the power of marketing can take it into a different space, and India in 2015 and beyond is also going to take it beyond.
And now we would like to call on stage a few individuals without whom this event wouldn't be possible.
Leo, thank you so much for speaking with us, and congratulations on the beginning of the Swatantra series. In your experience, in your opinion, is this the right time for a normal retail investor who's never had anything to do with the equity markets to get started?
Actually, this is something our research team has looked at as well, and our view is that it's certainly not too late, if that's a part of the question, to enter a rally which is probably just a few months in. Having looked at previous bull market rallies in the country, going back 20 years or so, our sense is that what we are witnessing at this point is potentially something that could last 3 years, if not longer, in terms of a secular trend. So I don't think investors who have not participated so far should feel that it's too late. We are still very early in the rally.
There's a tendency from analysts to sort of put benchmarks expectations right now. So we're talking, a lot of people are talking about, 10,000 on the Nifty. We're talking about, 1 lakh on the Sensex in some point of time. Do you share any of that optimism? Or in-house at UTI, do you have a target right now that you're looking at for the Sensex or the Nifty?
No, I don't think we are in the business of setting those kinds of targets. And I think that does a disservice to the retail industry, because that is hype, and that's precisely the kind of communication that leads to problems for the industry later on. I think when we talk about a secular bull run, we are talking about what we believe is a more realistic goal of 15 to 20% steady growth in earnings, which will then in turn support growth in valuations. And you can see that for the obvious reasons that inflation is trending down, which will help rates to come down, relatively benign macro, and valuations which no longer, while they may not be cheap, are at least fair at this point in time. So if you take all of that, and if you believe that you will see some investment momentum come back, which today is the one question mark, because as you know, credit growth has actually been a little slow. If credit growth does pick up, which will imply investment confidence returning, I think you will then really have a very strong foundation for a 3-year progressive value creation opportunity.
Well, It's interesting that you say 3 years, because the challenge with mutual funds for a long time has been to get investors to view them as long-term instruments, because investors for some reason tend to view them as 1 year, 2 year, 3 year products. Is that a challenge that UTI has plans to battle right now? Because a lot of your communication is now talking about retirement, is now talking about long-term goals. So how do we tackle the fact that mutual funds are not being viewed as long-term instruments in India?
I think that is the central challenge that we have. I think for the average retail investor, the right way to think about a mutual fund is as a form of medium to long-term savings. And what that means is you need to have a minimum horizon, ideally of 3 years, but it could potentially be as long as 10 or 15 or 20, depending on how young you are when you start, if you like, or indeed 20 or 30 years if you're young enough and smart enough to start young enough. And the industry and UTI as well have particularly stressed, therefore, the importance of systematic investing, provided you start early enough. I think there's a small segment of investors who can afford to take sharper views. And I think for them, sophisticated investors or high net worth investors, they may be able to take sharper views using mutual funds, for example, to take sector bets or to take short-term bets. And I don't think that's inappropriate, provided that is being done by sophisticated investors or those who can afford to. But certainly for the retail investor, that is an inappropriate way to actually view a mutual fund. And our investor education is very strongly focused on underlining that message.
I want to very quickly ask you right now, when UTI approaches the market, are there any sectors that you're particularly bullish on going forward into the next 6 months, or at least up till the union budget?
I think our view has always been to look at stocks, and I think when you talk to most leading fund managers, they will tell you, particularly in a market like India, which is not yet very deep, you're wiser to actually look at stocks rather than sectors. It is true that you will have periods of time when certain sectors will appear to be on fire. I think recently PSU banks, infrastructure, and so on have been sectors that have looked quite strong. But our view is to stay a little detached from that. The previous experience with sector funds has been quite mixed. I think many funds, including us, had infrastructure funds, for example, which may have worked out if people were able to time the market. But if you were not, obviously you were left nursing heavy losses, which perhaps you are only recovering from now. So I would still recommend for the average retail investor a core portfolio of a diversified fund for the most part, and then use a sector or a mid-cap or small-cap fund more as a way to sharpen a point of view and not at all as a means to build a core portfolio.
It's time for us to take a very quick break, but when we come back, Leo Puri is going to stay with us. We'll talk about investment advice for young people and for women. Don't go anywhere. Welcome back. You're watching ET Now. I'm in conversation with Leo Puri. We're talking about how we should make the most of the market over the next few years. But since we're talking about the Swatantra series, while new retail investors or retail investors who perhaps burnt their fingers, in 2008 or 2009, when they come back into the market, one of the risks we face is of misinformation or the lack of education. UTI as a company, being one of the brands that are most trusted in the market right now, what are you doing to make sure that A, your intermediaries are passing on good, correct advice, and B, you're educating your customers to make educated decisions?
Yeah, I think as you suggest, it's our responsibility to educate both our intermediaries, our independent advisors, as well as our end investors. And I think we have very clear strategies for doing both. In terms of product positioning, I think we very clearly clarify with all our distributors where we actually think specific products should be positioned, what their value proposition is, and the type of investor for whom they're suitable, and therefore how they should be ideally positioned or distributed. To the end investor, we reach out directly. Swatantra is perhaps the most visible form in which we do that. And the feedback that we have got is very positive because it's an independent platform where essentially independent experts and advisors share their views and guidance for households in India as to how they should think about products, portfolio allocation, redemption, saving for the future, and so on. I think one of the things we could perhaps as an industry do better is also think about reaching the middle and the next, if you like, segment of the pyramid, for which we will need new techniques, maybe regional languages, maybe more use of electronic media, and I certainly hope that we'll step up our effort on that.
Well, one of the target audiences that your team keeps mentioning are young people, and perhaps there is, a need here to bring UTI as a brand closer to the younger population or the younger investor in this country. How do you suppose to do that right now? Internally, is there a plan at force? What are you doing to make it more attractive perhaps to younger investors?
All the research that we have looked at shows that the level of financial literacy amongst the younger generation is quite poor, in fact. Here we have to rethink the way in which we use investor education. I think it's a digital world where people don't have the capacity anymore to absorb large amounts of information. I regret that personally, but it's a reality, and you have to accept that there needs to be a level of entertainment, there needs to be a level of easily digested content. It needs to be shorter, it needs to be more concise, it needs to be in formats that they will use on devices that they will typically access them. And I don't think we've quite got there yet, but as we speak, we are thinking quite hard about how to reformat our investor communication.
Well, one of the unique things about UTI is that you have investors who've stayed with you for decades. Do you think now it's time for regulators to consider pensions through mutual funds? It's been a demand that pension money should be, AMC should be allowed to manage pension money, or a mutual fund should be allowed to launch a pension version of the fund. Do you think it's time now for us to encourage that long-term savings to move into mutual funds or to move into part equity at least?
Yeah, there is absolutely no logic for a regulation that prevents insurance and pension companies from outsourcing mutual funds. They should not be forced to do so. They should simply be permitted to do so, which just means that they can evaluate the relative value that asset managers would bring to their business and ultimately to their policyholders and their pensioners. So it's a win-win for everybody. They would get an opportunity to get access to scale and professionalism in terms of the management of assets. The end investors or pensioners would benefit in terms of the security of knowing that they are getting access on a continuous basis to the best that's available in the market. And the asset management industry, which in turn supports the growth of capital markets, gets to grow as well. So whether you think of it in terms of capital market development, whether you think of it in terms of actually investor security, or whether you think of it in terms of just growing the pension base in this country, it's a very, very logical thing to do. So I see absolutely no reason. This should have happened yesterday, and certainly I'm quite optimistic that the moment our policymakers actually reflect on this, they will come to the conclusion there is really no reason not to permit this. Again, I would stress nobody is expecting any favors or suggesting there should be any push or direction either. Simply just a withdrawal of the impediment and then let the market work its way through the opportunity.
Are you also of the opinion that India needs a super regulator for its financial sector at this point, or are we regulated enough as it is?
I'm not sure at this point the answer is simply a super regulator. I think before you get to that, you need to actually solve problems within the different regulatory verticals and problems of coordination across verticals. And I think if we don't learn how to do that, it's not going to help by simply imposing another layer on top of the chaos that exists today. So we do have a certain amount of chaos in the sense that we do have arbitrage between sectors. We do have sometimes a visible lack of alignment between regulators who are regulating the same institution, who have subsidiaries in different businesses. And I would say the FSLRC was broadly on the right tracks in terms of at least setting up a coordination mechanism for alignment. And I think that would be a good start. the evidence around super-regulation, unfortunately, elsewhere in the world has not been uniformly positive, partly because the complexity of doing that well has proven to be challenging. So unless you've matured to a point where your regulatory infrastructure and the sophistication of the people, the talent you have, the knowledge and understanding you have in regulatory bodies has evolved to some level of maturity, it would actually be dangerous, in my view, to simply add yet another bureaucratic statutory body, in effect, on top of all of this, without recognizing that there's plenty of issues that we need to tackle before we get there.
Well, we've talked about innovation in brand and communication. I want to also talk about innovation in product at this point. From inside UTI, what are you focusing on? What are the products you think investors will find most attractive going into and through this bull run over the next 3 years?
I think actually if you look at our portfolio, the first point I'd make is that broadly we do have a fairly complete set of products. In fact, through its history, UTI has been a pioneer and innovator, whether it was a ULIP, which was the first of its kind, a retirement benefit plan. We're one of only 2 funds that has that, children's career plan, which was the idea of saving for children till they attain the age of maturity, schemes for women, we have pensions for teachers. So there's a set of products that we would typically develop for certain segments, sometimes to encourage financial inclusion, sometimes to meet broader life goals, if you like. And I think that to us is an ongoing part of what we keep doing. So we do have a program underway both to look at financial inclusion kind of products, such as the teacher's pension, and we've done something with Seva Bank as well. We have a women's scheme which is, I think, doing quite well. And similarly, I think we are looking at products that will offer portfolio allocation or diversification as well. We did launch a sort of capital guaranteed product as well for the segment of customers that might want the security of capital protection, if you like, and yet participate in some upside. And those are the sorts of things. Having said that, I think the issue here, in my view, being somewhat frank about it, is less about the need for more and more innovation, but more about the need for more appropriate positioning of products. I think certainly at UTI we broadly have the elements of what could be composed to meet most anticipated needs, but understanding which products and which combinations should be actually ideally positioned with a particular profile of investor is where the industry has made its big missteps in the past. And certainly I'm very conscious that we must learn from that, because a bull market is, of course, the time for the worst mistakes to be made. And I think as an industry we have failed to learn from the excesses of the last bull market. We will indeed pay a fairly heavy price. So I think we are doing our best to be very, very cautious and underline the point that, yes, there are good times for the industry, but we must spend more time focusing on the correct positioning of the products for the right segments of customers.
It's time for another very quick break. When we come back, we'll talk about using mutual funds to plan for our retirements. Don't go anywhere. Welcome back. You're watching ET Now. We're in conversation with Leo Puri of UTI Mutual Fund. For the benefit of women investors who, in my experience, tend to lean towards fixed income because they like the fact that it keeps their money safe. And like you mentioned, there are a group of investors who like capital guarantees. Would you say the next 10 or 15 years, India being poised for the kind of growth that we expected to see, would you say this is a time for capital guarantees and for fixed income, or would I be better off doing, starting an SIP in a well-chosen fund for the next 20 years?
I think for anyone who has the time horizon before them, it would be a mistake not to have a reasonable part of their portfolio invested in equities. The balance between investing in a lump sum or a systematic investment plan is a function of capacity as well as age, if you like. But there is no doubt that systematically investing in equities will significantly outperform, certainly bank deposits or bonds or typical insurance endowment products. It has done so for just about any time period that you look back, since you can actually track data on our stock exchanges, or for that matter, most exchanges anywhere in the world. I think the challenge that people have is obviously in trying to time the markets. It's a human temptation, that desire to make that little bit extra, and that's the cycle of greed and fear, which we just have to try our best to overcome. It is easier said than done. Much of the investor communication that we undertake is to try and neutralize the twin polarities of greed and fear as being the primary basis for investment decisions. And that is, of course, what has explained why investors have typically tended to enter at the top of cycles and exit at the bottom. And that's why no matter how much we may show them broad macro data, their own experience doesn't match that, because they have tried to time the market. So timing the market is something certainly I don't think I've ever been capable of doing. I wouldn't recommend it to most people. It's an adventure sport, I guess. Some people like bungee jumping. Some people think they can time the market. But frankly, that's all it is if you're going to do that. You really are much better off actually thinking about either putting in a sum of money, if you can afford it, as a lump sum, and leaving it for a reasonable duration, or indeed if you are in your years where you're building up savings, to start with systematic investment, or put your children into systematic investment plans and see how that will actually do. If you are an elderly person who needs income, then other products such as capital protection and monthly income plans and so on are also well suited. And that's why I don't want to discount the importance of those products in the portfolios for people at a certain stage in their life cycle, or who have other needs they're trying to meet.
But according to me, one of the most efficient products we have in our market is the equity linked savings scheme that allows you, a tax break or a tax deduction when you start off, and after 3 years, all the returns are tax-free anyways. But somehow it has to compete in that basket with the PPF and ULIPs and a lot of other things. Would you recommend that anybody looking at, a tax deduction for this year, given the kind of returns we've seen ELSS display over the last couple of years, would you say ELSS right now should be top of mind, should be the choice that all investors use?
Yeah, I think they should absolutely consider ELSS. As you know, the issue is that the tax deduction competes with a number of other instruments. It's not exclusive to the ELSS product alone. But I think compared to some of the alternatives as to how one could use that tax deduction, that benefit, it does tend to, again, outperform. I would actually make the point that we should raise the overall limits, the 1.5 lakhs and so on. I think it needs to keep up with the times. And if we're going to encourage a true long-term savings market in this country, that limit needs to be much, much higher. It has really not kept pace with either earnings capacity or inflation. And I think it needs to be a multiple of what it is to actually benefit the rising middle class in this country.
Do you think lock-ins also need to be looked at a little closely? Somehow when the ELSS has a 3-year lock-in, the investor tends to believe that after 3 years he needs to pull his money out, which is not the case. Perhaps if we want to encourage long-term savings with a larger tax deduction, should it have a slightly longer lock-in as well?
Yeah, I think, again, there are products there are short-term, medium, long-term. I think you would, if it's a long-term horizon, then some form of a pension product is probably ideal, and the tax incentives should be aligned towards that. So to be fair, I would say that what we really need to encourage is an underlying pension proposition which is better structured. There's talk that the mutual fund linked retirement plan might come into being. It's still on the drawing board at this point. But again, unless you actually have common regulation. Today that's split between PFRDA, SEBI, and to some extent the insurance sector. It comes back to your earlier question on coordination amongst regulators. The pension industry is a perfect example of an industry which is in crying need, actually, for better harmonization in terms of cost of manufacturing, cost of distribution, and transparency of yield and return. And on top of all that, tax harmonization. You need all these elements to be in place before you can actually give a very strong push to the pension industry. And I would take that up as a test case for the FSLRC to see if indeed we can demonstrate that coordination in a regulatory sense.
Leo, before I let you go, I want a word of advice from you to Indian investors who are watching at home right now, retail investors who are wondering what to do next. What would your advice be?
I would say don't be unnecessarily risk averse and don't be driven by the cycles of greed and fear. Think about actually systematically investing, increasing your exposure to equity markets. We are in perhaps one of the best parts of the world you can imagine to actually participate in industrial and economic growth. The equity markets are a wonderful opportunity to do that, but they are not a casino. They are essentially a commitment you need to make, and the mutual fund industry certainly offers an avenue through which you can safely make that commitment. But please don't allow this opportunity to pass you by.
Thank you so much for spending time with us, and congratulations on Swatantra.
Thank you.
Remember, the Swatantra series begins on ET Now. Stay with us for advice, for guidance, and of course, write in with any question you might have about investing. Thanks for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.